Inflation over the long run is about 3%. This includes some outlier years, but on average, that's what it is. This is important for a couple of reasons. First, you have to realize what your hurdle is. You have to beat inflation in order to maintain wealth. Since 1926, the US stock market has returned 10% per year. That means a real return of 7%, which is pretty good. Compounded over 50 years at a 10% return, a $100,000 investment turns into $14.5 million. This is the power of compound growth. Now, 50 years ago, $14.5 million was about 3 times more in terms of purchasing power. But still, that's pretty good. Now, going forward, we might have better returns because of AI, but even at 8%, which is 5% real return, that's pretty good. This is 5% compounded over 50 years, which still gives you 12 times your purchasing power. The second reason why inflation is important is because it affects real rates. A real interest rate is the rate of interest an investor can expect after allowing for inflation. This is what affects discount rates and therefore equity prices. There are some complaints about CPI being used. It doesn't really take into account medical costs or education costs, at least not very well, but more or less this is the game you're playing.